Good morning, everybody. For those of you that have already joined, welcome. We're just gonna give the participants a couple of minutes to log in. So I say we start 10 minutes past 2 p.m., but we're looking forward to a very engaging session and welcome to the webinar. Great. Thank you, everybody that has already joined. We shall be beginning now. Welcome. Good morning, good afternoon, good evening, depending on which part of the world you are joining us from. My name is Mary Ongore, and I am the legal manager at International Lawyers Project. Uh, this is a UK-based NGO that leverages on pro bono assistance to achieve economic, environmental, debt justice, among others. So I will begin with a brief scene setting intro, following which Ni will come in and talk about the purpose of the meeting. We shall then have a keynote address from Professor Nana Ama Brown Klutze, and the presenters, and the presentation from Norton Rose Fulbright, and these are the pro bono lawyers that worked on the guidelines. So before I commence, I think it is critical, like I said, to set the scene and talk about why we're here today and what we're hoping to achieve. And as you may well know, climate change is a significant challenge for African countries in particular because they are the most vulnerable to the impacts of climate change, despite the fact that they contribute the least to global greenhouse gas emissions. And you can see this from severe climate impacts that have already taken place. For example, we have rising temperatures. And for those of you that were following as of last year, we had the global average temperatures surpassing the 1.5 degrees Celsius above pre-industrial levels for the first time. So that is of concern. Of course, we've also had other extreme weather events such as floods, cyclones, storms, and shifting rainfall patterns. And these are particularly important for countries in Africa, again, like I said, because we have a high dependence on climate sensitive sectors. So, this is including agriculture, forestry, fishing, tourism, etc. All of these economic sectors are heavily dependent on the weather. Okay, and just to sort of put that further into context, we have over 60% of the workforce in sub-Saharan Africa relying on rain-fed agriculture. So that is why we are here. We want to know how is it that we can mitigate and adapt through the use of what we call green bonds. And green bonds are essentially debt instruments that aim to raise funds for projects with environmental benefits. These have been around for some time, with the first one being launched, I believe, in 2007 by the European Investment Bank. And since then, they have gained a lot of popularity, and several standards have been raised or rather issued that touch on how green bonds work and what we should be looking out for. And largely the aim, like I said, with green bonds is to invest in, for instance, climate change mitigation, climate change adaptation, and biodiversity protection. And guidelines aim um, to standardize and to regulate the use of green bonds in order, for instance, to standardize how proceeds that are collected are used, how do you evaluate projects, how do we manage proceeds, and how do we report. And they're absolutely critical in ensuring that we avoid misleading claims, that climate change is being mitigated through what we call greenwashing. They also aim to assist with transparency and accountability, and finally with the alignment with the SDGs and the Paris Agreement. So, like I said, several African countries have issued green bond guidelines or some sort of framework, and we're here today to discuss and unpack the securities industry green bond guidelines. So, with that brief intro, I will now hand over to Ni Ado. Ni Ado is the executive director at Green Tax Youth Africa. Ni, the floor is yours.
Thank you very much, Mary. Can you hear me?
Perfectly.
Thank you. Thank you very much. I think you've set the tone, and it's quite important that as part of engaging with stakeholders, we understand the purpose for which we are meeting here today. Now, sorry, hello, can you hear me? So, like I'm saying, as part of our advocacy engagement, we looking at how we can raise funds, because when you look at the international fund to help in financing the climate change, with transition from MDGs to SDGs, but yet Agenda 2030 so we have had the instance where developing partners have committed that, I mean, they are going to give 100 billion to developing countries as part of addressing the climate change agenda. But all those have their own strings attached. We don't know whether the 100 billion is adding through loan facility or the aid or the grant that they are giving to us. So in looking at all these issues, there's another way that we can raise funds. And raising funds is by taxing. I mean, like I said, nobody wants to be taxed. But to address the climate gaps, there's a need for us to focus on where we can get money internally to finance our own development. And that is what we looked at as Green Tax Credit Africa, to look at the guidelines in terms of the industry, green bond industry guidelines that we have in Ghana. And we went through that and we realized that there are some issues around how the proceeds are being utilized. So there's a need for us to look at, compare it to international best practices to see what other countries are doing and how we can be able to refocus this framework to ensure that we propose some funding measures or revenue measures to the government. And that is what started with this research or analysis. Now, beyond that, there's also an opportunity for us to look at how those monies, when they have arrived, can be used. And of course, when you look at the China, you look at Asia, you look at Europe, they have, I mean, detailed some strategies in terms of addressing the gaps when it comes to climate change. And just a few years ago, we noticed the European Green Deal, where they are giving about 100 billion to citizens of Europe when they come out with technical, technology in terms of how to address the climate gap, and then some innovations. And these are skewed particularly to address the climate gap or the climate agenda. How do we, as Africans, help to refocus our intentions to so that okay, it is not always going about going to ask for money, but how do we ensure that within the business framework, within what we are doing, we can also raise our own internal fundings to finance this development agenda to address the gaps. So those were some of the discussions that develop into how we can address that gap. Then we look at the security industries or the green bond guidelines that we have in the country, and comparing it to some notes, we realize that there are things that Ghana can do, and there are things that we can upscale. So that if we are able to upscale those levels, we can be able to generate some funds to develop or to finance the climate agenda. So that is the purpose for which we roll out this intention to start this research. So you are here because you want to understand how the research started, and the next steps in terms of how do we ensure that even looking at it from Ghana, we can upscale it to the regional level, and ensure that other countries also take steps in that. It is not only by having the framework, but how to ensure that the framework is able to address the gaps. So those are very important and key issues that we will highlight going forward. From now, for now, I will leave the rest to Mary. Then we can take it forward from the rest. Thank you very much.
Thank you. Thank you so much, Ni, for that introduction. Now we'll move on to a keynote address from Professor Nana Ama Brony
Brown
Klutse.
Kuche,
Apologies.
yes,
Yeah, apologies
yes.
if I misspelled that. So Professor Nana is a director at Green Talk South Africa, and she's also the chief executive officer at the Environmental Protection Authority. Uh, she is also the head of department level 600 and 700 academic course advisor at the University of Ghana. She has contributed significantly to addressing environmental issues and promoting net zero, academic work, youth support, philanthropic work, and the ideas she brings to the table make her unique and an outstanding gift to Ghana and the world. So, Prof, the floor is yours.
I'm trying to check if Prof is here. Okay, so maybe we can just proceed because but she has communicated with me that she is joining.
So, sorry, you broke off a little bit. Shall we continue? Shall we wait?
Yes. Yes. I think Prof is joining, but maybe there are technical things. Maybe we can proceed so that when she joins, then we can allow her. Yeah.
Great. Okay, no problem. So, we'll switch things around a little bit. So the next part of this session will be the presentation of the analysis that was done by the team at Norton Rose Fulbright. Now, just by way of brief background, we will be hearing from James Morris. James is a partner in the Sydney office of Norton Rose Fulbright, one of the world's global law firms. And he is the head of the firm's Australian debt capital markets practice and the co-head of the firm's Asian financial services team. He has many years of experience working on domestic and international debt capital market transactions, and he has acted for issuers and banks on many domestic and international bond transactions, and as such has an in-depth knowledge of the financial institutions and infrastructure industries. He's also well known for his support of pro bono and community-based programs. He will be joined by Yang Shu, who is an associate also based in the Sydney office of Norton Rose Fulbright. And Young's practice covers debt capital markets, structured and corporate finance transactions, and he also works alongside James on many of these matters. So I'll hand over to James and Yang. Welcome. The floor is yours.
Gary, thank you very much, and Nee, thank you very much as well for your kind invitation to have us present to all the participants on this particular call. It's a delight for us, and a good evening from Australia from us to all of you. I guess the first question is, well, look, why are you hearing from some Australians in relation to this particular topic? And I think it's a fairly a simple answer, really. Australia has, for a very long time, been a leader in green bond issuance, and we've seen that development in the market here really continue in leaps and bounds over more than a decade. We're continuing to see consistent year-on-year growth in green bond issuance. And the second reason why you could be hearing from an Australian, an American, someone in the UK, is that green bond principles and green bonds have really developed on a relatively standardized basis to a certain extent across the world. And you'll see a lot of similarities in relation to green bonds being adopted by various countries around the world. And relevantly for the purposes of this call, it includes the approach taken currently by Australia and the approach being looked at by Ghana. So we were very kindly engaged by GTYA in early 2024. It seems like not that long ago, but we've been looking at this for a while to conduct a comparative analysis of the Ghana Securities Industry Green Bond Guidelines of 2024, which I'll just refer to as the Ghanaian Guidelines, against the approach taken by bond issuers in Australia when it comes to issuing green bonds. And we looked at a variety of things as part of our review. We looked at the background between both the approach taken in terms of the Australian government green bond framework, the Ghanaian guidelines, really against what's seen as some of the world standards in terms of the green bond principles issued by the International Capital Markets Association. And there are a lot of similarities between the approaches, as you would expect. There are also some differences, and we'll touch on those as we go through. We also had a look at an analysis of issuer accountability, which is a crucial point in terms of green bonds, both under the ICMA, the International Capital Markets Association Green Bond Principles, the Australian Government Framework, and contrasted those against accountability under the Ghanaian guidelines. And we had a review generally of the application of the core principles, which are crucial to the way the ICMA Green Bond Principles work, both in Australia and Ghana, respectively. And we'll touch on these in a bit more detail later. But just to set the scene, these relate to things that go to the heart of what makes a bond green, or how you can say a bond is green. So we're looking at things like the use of proceeds, how the proceeds from the bonds are used, how the relevant green project is evaluated and in fact selected. Once the proceeds come in, how those proceeds are managed or held, and then accountability, super important. So we'll look at and looked at the relevant reporting requirements under each standard. Now, I've referred to the Australian government framework a few times already. It's worth noting that the framework we have for green bonds that the Australian government has put out, and this is to do with bonds being issued by the government itself, other non-government Australian green bond issuers may elect to use other frameworks in Australia, but where they do, it tends to go back to the ICMA green bond principles. But as I've said already, there are quite a lot of similarities between the approaches. So what did we actually find when we when we did the analysis. So we'll very, very quickly sum up our findings and then go into them in a little bit more detail. So within the scope of our review, and again, we're comparing the Ghanaian guidelines with the Australian government framework and the green bond principles, our analysis showed really quite a high degree of correlation and similarity between the guidelines in Ghana and the green bond principles, and therefore the Australian government framework as well, which is very much based off those green bond principles. But what are the green bond principles? So just to set the scene again, they seek to support issuers in financing environmentally sound and sustainable projects that foster a net zero emissions economy and protect the environment. The idea being that alignment by an issuer of bonds to these principles should provide transparent green credentials alongside an investment opportunity. What we did find, though, is that, interestingly, the Ghanaian guidelines are arguably more robust than the green bond principles in certain aspects. And crucially, these include with respect to disclosure and compliance requirements, coupled with, which is unique in some respects, the provision of a penalty regime where there's non-compliance. The other point to note, which is, again, we found quite interesting, is that the Ghanaian guidelines apply mandatorily to the issuance of green bonds in Ghana. They're not voluntary schemes that you sign up to. And I'll just pause there because I can see Professor Nana has a hand up. So I don't know whether you wanted to ask a question now or whether we should continue.
Hi, James. So, yes, you're right. Professor Nana has joined us now and her hand is up. I'm made to understand that she will have another meeting to jump into. So, can we kindly ask that we allow her to sort of speak? I know that will interrupt you briefly. Apologies for that.
Absolutely fine. I've got to the end of the summary. So before I
Okay.
launch into the excitement of green bonds and the principles, very happy to hand the floor over.
All right. Thanks, Nana. Thanks, James. Prof, go ahead. I think your microphone is on mute. Okay. Prof, your microphone is muted. We can't hear you.
Hello, Prof. Please, you have access to unmute your mic from your end.
Ni, are you able to unmute her mic?
Yes, I have, but I think it's also on her side. I don't know why. Because I don't see unmute her mic here.
It's fine. It's fine now.
Okay.
Can you hear me?
Yes.
Yeah,
Yes,
we can hear.
Hello.
Sorry.
It's enabled now. Yeah, I'm sorry for this. I mean, yes, I was just waiting for my mic to be enabled. So sorry for this. Thanks to the presenter, I didn't get the name, but I heard virtually everything he said. So I was trying. That's why I raised my hand just to see if that button works. And it's good you saw it. So thank you. We want to talk on this validation of analysis of Ghana's Green Bond Guidelines meeting. And I'm happy with the theme unlocking domestic climate finance for innovation and inclusive development. So I was given the assignment to give the keynote address. If I may, should
Yes,
I go
please.
ahead? Thank
Yes,
Yes,
please.
please.
you. Distinguished guests, government representative, development partners, civil society organizations, my colleagues in academia, youth leaders, ladies and gentlemen. It is indeed a great honor to address you today as this maiden presentation of the analysis of Ghana's Green Bond Guidelines. This is spearheaded by the Green Tax Youth Africa in collaboration with the International Lawyers Partnership and the Northern Rose Fulbright Australia. So this gathering comes at a pivotal moment in our nation's development journey. Around the world, the urgency of climate action has never been more evident. Yet, at the same time, international climate finance flows are proving to be inconsistent and insufficient. We will all recall that the 100 billion US dollar annual pledge by developed countries under the UN Climate Accords, first targeted for 2020 and later extended to 2025, was only met in 2022, 2 years late. And most recently, the fourth International Conference on Financing for Development in Seville failed to produce binding commitments, leaving many nations, including ours, Ghana, searching for sustainable solutions. It is in this context that Ghana's leadership in mobilizing domestic resources for climate innovation becomes not just desirable, but very essential. The analysis we launched today examines our green bond guidelines with a sharp evidence-based lens, benchmarking them against the Australian Green Bond principles. It identifies policy gaps, explores opportunities for alignment, and ultimately aims to ensure that proceeds from green bonds are invested in projects that are both climate responsive and socially inclusive. From the EPA, or me as the CEO, and also the chairman of the green the GTYA. The work speaks to a core truth that if we do not take ownership of financing our climate ambitions, we will remain dependent on promises that may never be fulfilled. So this meeting or launching, it's important. First, it validates that Ghana has taken important steps to develop a structured framework for green bonds under our securities industry law. Second, it offers a pathway to raise international revenue without overburdening our physical space by linking environmental stewardship with innovative finance mechanisms. Third, it emphasizes equity, ensuring that benefits of climate investment flow to our youth, women, and the marginalized communities. The fourth, it situates Ghana in the emerging global green finance marketplace, attracting responsible investors aligned with sustainability standards. I want to also leave you with 4 key recommendations for leveraging green bonds to raise international climate innovation revenue. We must refine the Ghana Green Bond Guidelines into a binding regulatory framework underpinned by enforceable standards, clear eligibility criteria, and robust monitoring. This will ensure investors' confidence, reduce risk, and attract both domestic and diaspora capital for climate projects. Two, we need to proceed from green bonds proceeds from green bonds should be ring-fenced into a national climate innovation fund. This will guarantee that funds directly finance renewable energy, sustainable transport, resilient agriculture, and other transformative projects that will ensure traceability and measurable impact. On tax, offering tax breaks to companies and investment purchasing certified green bonds and applying environmental levies on high carbon industries can both mobilize resources and accelerate the shift towards low carbon solutions. And we need to leverage public private youth partnerships. So we're enhancing the dynamism of youth led innovation hubs, private sector financing, and government backed guarantee can create scalable green solutions while building local infrastructure and service capabilities that generate jobs. Ladies and gentlemen, the path forward requires that we move from research to policy, from policy to implementation, and from implementation to measurable change. Ghana's green finance future depends on bold, decisive steps that marry fiscal prudence with environmental ambition. I commend the Green Tax Youth Africa for this pioneering work, and I invite all of you government agencies, development partners, investment, and civil society to partner with us. Together, we can ensure that Ghana's Green Bond Framework becomes a model for Africa, a tool not just for financing climate resilience, but for shaping a future where economic growth and environmental sustainability go hand in hand. I wish to thank you and wish you the best in the deliberations. Thank you.
Thank you so much, Prof. I think we can now go back to James. Will be followed by Yang. Just to sort of to emphasize, if you have any questions, please feel free to use the Q&A button to pose your questions. Great, thank you. James, back over to you.
Thank you, Mary, and thank you, Professor Nana. I think there were some really salient observations in your keynote speech there around the real impact that sustainable and green financing can potentially have in all countries. So that was certainly very interesting for us to listen to. So what I might do is just take a step back for not being familiar with everyone on the call, and just go right back to basics in terms of what we're actually talking about here in terms of the financing instrument itself. So as Mary touched upon right back at the beginning, we're talking about bonds. So what is actually a bond at its essence? It's a fixed income debt instrument by which investors lend money to the party issuing the bond and represents a debt owed by the issuer to bondholders. It's an instrument by which the issuer, in return for getting the money from the bondholders, typically pays interest. It might be a fixed rate of interest, a variable rate of interest to the bondholders over usually the life of the bond, the maturity of the bond, and at the end of the bond's life, at its maturity date, the issuer will usually redeem the bond for its face value, sometimes a different amount, but usually its face value, together with any unpaid interest at the time. And it's a contractual agreement between the issuer and the bondholder. So that's a bond. A green bond, which is obviously what we're all here to talk about, is one that, broadly speaking, meets all of the same criteria. It's still a bond, but the proceeds from that bond raised are targeted at making positive environmental impacts. Very, very much what Professor Nana was talking about. So what I'll do now is just shift briefly, and I promise I won't talk the whole time. I will pass to my colleague Yang in due course, so you won't have to listen to my voice for the entire presentation. What we're going to have a look at now is really a consideration of the green bond principles, the Australian government framework, which again incorporates those principles, and the Ghanaian guidelines, and look at some of the differences, some of the similarities. So the important point to note, and this is why Australia is relevant in this context and in the context of your guidelines, both the Australian government framework and the Ghanaian guidelines each follow the precedent or really the formulations set by the green bond principles to a majority extent. So because of that, there's a high degree of similarity when compared with the approach taken by green bond issuers in Australia under the green bond principles and the Australian government pursuant to the Australian government framework. Remember, I said that non-government issuers have a choice and typically will adopt the green bond principles in our country. An important point of contrast, though, is that your guidelines apply mandatorily to green bond issuances in the country, albeit with some limited exceptions for government entities. So fundamentally, that means green bonds in Ghana are government regulated under the guidelines, rather than, as we see in other countries, including Australia, more market regulated as bonds that are issued pursuant to the ICMA green bond principles would be. So rather than being government regulated, the market in the context of those other bonds essentially demands compliance with the green bond principles if you're issuing a green bond. So what does that actually mean? Well, the implication is that Ghanaian issuers of green bonds must comply with the guidelines, regardless of whether they view them as more or less favourable than the green bond principles. And that's because they're government regulated. And regardless, in that regard, of what the broader regional and global market position might be as a result of issuing a bond that complies with those guidelines. Secondly, the Ghanaian guidelines require a disclosure document to be approved by the Securities and Exchange Commission of Ghana and provide for restrictions and financial penalties to be imposed where there is a breach. What we see in other frameworks is that there aren't these penalty regimes. So yeah, that is quite a powerful tool, subject to some commentary that we've got in terms of ensuring compliance or trying to ensure compliance with the guidelines. But what all the frameworks have in common, and a real crucial feature, is the adoption of the ICMA Green Bond Principles core principles, of which there are 4. And they're adopted equally by both the Ghanaian guidelines and the Australian government framework. These involve, as I said, 4 things. Firstly, the use of proceeds. So in short, funds must be used for a project in a manner that provides clear benefits to the environment. Secondly, there must be a process for project evaluation and selection. So you have to pick something that is actually green, and you must communicate a transparent methodology with respect to applying the proceeds of the bonds to that project and how that project fits within the green bond principles. Hand in hand with that is the third point, and that's around how you manage the proceeds that come in from issuing the green bonds. And the crucial point here under the green bond principles is that the proceeds that you get in as an issuer from issuing a green bond should be able to be specifically identifiable and also tracked for the life of the project, so you know where the money has gone. And that may need to be segregated in a sub-account, something that we'll touch on very shortly. Then the final one of the 4 principles is all around reporting. So the principle essentially states that issuers should provide updated and readily available information with respect to how proceeds of the issuance are used and track each project that proceeds are applied towards. So what I might do there is just have a brief pause, both to give you a break from my voice, but I'm also going to hand over to my colleague Yang to address our findings and give some commentary regarding each of the 4 core principles. Over to you, Yang.
All right, thanks, James, and hi, everyone. So as James said, we're going to go over the 4 core principles that are common to each of the frameworks and sort of raise and highlight to the audience where the key differences are and some of the commentary that we have around that. So in respect of the first core principle, as it relates to the use of proceeds, obviously proceeds from green bond issuances need to be used to finance or refinance projects that benefit the environment. So these would include typically things like renewable energy projects, green buildings, reducing plastics, and building or providing energy efficient housing and upgrading housing in that same manner. So within this core principle, the Australian government framework is unique as it includes a 1-year look back period. What this 1-year look back period means is a period of time in which the government can retroactively allocate funds to a project before the bond was issued. So in essence, a project that might be green is commenced in 2024, but the government raises money in 2025. And because 2024 is a year prior to 2025, said project would be, in theory, eligible to be funded by those funds raised in 2025 by the Australian government. So part of the rationale, we think, is because this is a governmental policy. The Australian government would like to be seen as supporting and building the nation of Australia up and supporting green infrastructure that is new, rather than simply cashing out investors of existing green projects. So moving on to the second point, or second core principle, as it relates to the process for project evaluation and selection. Each framework here broadly adheres to the same principles, but in our view, the Ghanaian guidelines go a bit further than the green bond principles under ICMA's guidelines or the Australian government framework by requiring that green bond issuers make continuous disclosure to the public, and in particular upon the request of certain stakeholders, i.e. bondholders, this information has to be disclosed throughout the life of the bonds. And in this manner, we consider that the Ghanaian guidelines provide a higher degree of transparency versus in comparison against the GBP, Green Bond Principles, or the Australian government framework. So that was a relatively consistent core principle across each of the frameworks. So there wasn't too much to discuss in that respect. And in terms of the third core principle, as it relates to the management of proceeds, there are 2 key differences between the Ghanaian guidelines that we wanted to highlight in comparison to the Australian government framework and the green bond principles. So the first point of differentiation is that an issuer of green bonds is required under the Ghanaian guidelines to open a separate bank account and, if applicable, a sub-account to that first bank account. And proceeds need to be credited in those relevant or applicable bank accounts. And this is in contrast to the green bond principles under ICMA's guidelines, which permits the tracking of the funds by the issuer in an appropriate manner if the issuer does not choose to segregate it with a separate account. So what that basically says is, under the ICMA rules, you're allowed to have one account for every single dollar of money that you raise under a green bond, but you just have to keep a separate ledger entry, if you will, in terms of from an accounting perspective. So what we think is the difference here is that the Ghanaian guidelines provides a clear trail of how proceeds are to be used, and thus promotes greater certainty from investors' perspectives as to how the money is used and applied. The second point of differentiation is between the Ghanaian guidelines and the Australian government framework. So under the Australian government framework, proceeds of the bonds are to be fully allocated within 2 financial years from issue. Again, we think this could be explained by the fact that the Australian government framework applies to the Australian government issuances, which is funded by taxpayer dollars. So arguably, there is a high level of accountability in terms of spending public taxpayer money. In contrast, issuers under the Ghanaian guidelines would likely be private sector enterprises, especially with keeping in mind that the guidelines apply to everyone but for a limited number of government entities. So moving on to reporting as a core principle under the frameworks, we consider that the reporting guide requirements under the Ghanaian guidelines is significantly broader when compared with the other frameworks. So there are a list of requirements under the Ghanaian guidelines which expand on the core principles, namely that a change in an impact measurement indicator under the Ghanaian guidelines is disclosable under it, and the issuer must include reasons why that change was made. Furthermore, continuous disclosure in respect of that change must be provided for a period of 12 months after that change is made and disclosed. Another point is that the Ghanaian guidelines require immediate disclosure of material developments in connection with projects financed or refinanced by green bonds, which is in addition to and on top of annual reporting requirements that are common to the green bond principles and the Australian government framework. So the Ghanaian guidelines codifies ICMA's recommendations under the green bond principles that an appropriately qualified independent party is required to verify an issuance's compliance with core principles, both before and after the issuance. And this is the third and final point of differentiation between the Ghanaian guidelines and the other frameworks as it relates to reporting. So what does this all mean for issue accountability under the Ghanaian guidelines? In our view, the fact that the Ghanaian guidelines apply mandatorily to issuers under the regime and includes penalties for not complying with the guidelines, this provides bondholders an additional layer of protection on top of the contractual rights that already exist. For comparative purposes, penalties for non-compliance under the Ghanaian guidelines range from approximately 580 Australian dollars to 23,000 Australian dollars, whereas penalties in Australia is proportionate to the damage. So one thing that we consider is relevant to flag here is the fact that there's potentially a big discrepancy between the value of the project and the amount of fines that may be applied under the Ghanaian guidelines. So by way of example, approximately $5.5 trillion is the maximum end of what penalties under the Australian regime would be for a breach of securities laws. And we consider this might be something that is worth stakeholders having a conversation over as it relates to accountability under the Ghanaian guidelines. So this all potentially raises some practical challenges, which I might hand over back to James to discuss with the audience. James, over to you.
Thanks, Shang. So look, we thought we might end just before we throw it over to any questions that people might have, just touching on a couple of practical challenges that the green bond environment throws up, and these are quite common across jurisdictions. And the big one that some of you may have heard of really relates to what's called greenwashing. Now, the greenwashing of bonds refers to essentially misleading or deceiving investors as to the environmental credentials in connection with an issuance of green bonds. In other words, the bond isn't as green as you say it is. Now, in Australia, our regulator regulates the issue of bonds, and in Australia, in August 2024, released quite a significant report on the action it's taken in relation to intervening where it sees there have been actions amounting to greenwashing. And these quite include, the interventions include quite severe penalties applied where institutions have got it wrong. Multi-million dollar Australian dollar civil penalties. Now, there's not a full breakdown of necessarily what sectors of the market received enforcement action or particular scrutiny, but it does highlight the fact that greenwashing is a real issue in this market, and it's something that regulators more and more around the world are supervising and also cracking down on. So quite a big issue. So applying that to the Ghana context, you can go some way to ensure there's no inadvertent greenwashing of bonds by basing green credentials on reasonable grounds, and those reasonable grounds would be driven by verifiable data and disclosure pursuant to the Ghanaian guidelines. And it's also quite apparent to us in this regard that the Commission has an important role to play in the regulation of Ghana's green bonds market to ensure compliance and also fair outcomes for both issuers and bondholders, and also the community more broadly. There's obviously stakeholders go well beyond the issuers and the bondholders involved in these transactions. And in addition, the continued disclosure obligations provide some weight and some comfort around greenwashing as well. Under your guidelines, there's a clear promotion of transparency and accountability, not only to bondholders but also to other affected stakeholders. So quite robust measures in our view on the face of the guidelines. So the second issue I just wanted to touch on very quickly is one of the real challenges is getting consistency in the green bond market. And you look at the way that the green bond markets have developed around the world and the year-on-year increases in issuance volume that we're seeing. It's a coveted label to issue a green bond at the moment. They're very popular amongst investors, but there is divergence around the standards that are available and what characteristics a bond must have to obtain a green label. So as we've touched on during the presentation, the green bond principles contain a certain set of standards and characteristics as to what constitutes a green bond under those standards. This is very similar but slightly different to other standards. A couple of examples being the Climate Bond Initiative's Climate Bonds Standard, and also the standard published by the European Union, which is the European Green Bond Standard Regulation. And the risk of divergence and divergence where issuers are able to voluntarily choose which standard they comply with, it clearly provides them some latitude, but it also gives rise to a risk that an issuer might well pick the most favourable standard. In fact, in many cases will pick the standard most favourable to it in terms of obtaining that green bond label. And in many ways, that can be seen as a form of greenwashing itself, and often is regulated as such. So one of the real benefits we see from the Ghanaian guidelines is the robustness of them. They're less prone to greenwashing. They're regulated. You don't have the same sort of taxonomy issues where you're mandating what the standards are and having them apply mandatorily to green bonds and prescribing that standard to which green bonds must comply. So it definitely lessens, in our view, the risk of greenwashing applying. They were really the key points we wanted to touch on for the purposes of the call, but Yang and I would be very happy to answer any questions that anyone on the call might have. Mary, I might throw it back to you to moderate any questions that come through.
Thank you, James and Yang, for walking us through the guidelines, what a green bond is, starting with core principles as well, that are in the ICMA principles. And I think we have one hand up. Ambassador Francis, happy for you to pose your question. I think your microphone is on mute. But if you can't unmute, please use the chat. See if I can. Ambassador Francis, I can't hear anything. Can you unmute your microphone? Okay. I think he had raised just a general question about whether the recording will be shared. Nee, I wonder if that will be possible. I know we are recording the session. But Nee, if you could just revert about whether the presentation will be shared. Not sure if Nee is on the call either. All right. It's okay. We seem to have lost Nee. I see there are a couple of hands up, but I'm not sure if you have the right to unmute your microphones. If not, please put in your, please put your questions in the chat. I think the microphones are disabled. So I'll ask the first question. How are investor concerns addressed if green bond proposals are rejected due to credibility issues?
Yang, did you want to take that one? Otherwise, I can address it generally. I mean, it's really driven by the market here in many ways. That if an issuer puts forward a bond and it doesn't meet the criteria for being labelled a green bond, then that is going to, if the issuer is targeting an investor base that is looking to invest in green bonds, where your investor base shrinks. It may not be catastrophic for the issuance, but it clearly will impact on the availability of certain funding. I guess the other question is, well, look, what are the consequences if the issuer gets it wrong, which I guess is the other half of that scenario. Well, that's where you have your penalty regime come in. Now, the challenge there is, well, what does that actually mean in practice? So if a penalty is levied under the Ghanaian guidelines against an issuer for non-compliance, for example, well, that's all well and good, but how is the penalty going to be applied? Is it going to be applied to rectify something that has resulted from the non-compliance to compensate the investor or in some cases broader stakeholders. So there's a little bit of potentially more clarity required as to where those penalty receipts are going to be applied and what benefit an investor or a stakeholder might get from those. Yang, did you have anything to add to that one?
Yeah, and I think I agree with all of that. The only thing that I might add is, so if I'm to understand the question, is sort of getting at what happens if funds are raised and then applied to some projects that aren't necessarily green. I think in that case, on top of everything that James has described just now, you'd also have the contractual protections under the issue program, under the contract. So whether or not that you enforce or not, yeah, there would be some sort of avenue of redress in that respect.
Great. Thank you for that, James and Yang. I have another couple of questions. I know you've touched on greenwashing, and I think maybe we could delve a little bit deeper for Sebastian from ActionAid Ghana. And the question is, what safeguards exist in project selection to prevent greenwashing?
So this comes down to essentially the analysis of the relevant project that's going to be funded by the proceeds of the bonds. So there's clearly, and as I touched on the during the presentation, clearly a role that the Commission has to ensure compliance and to ensure that projects that people are saying are green are in fact sufficiently green to satisfy the requirements. Now, you have some comfort through the penalty regime, as I touched on before, that is mandated under the guidelines. That's very different to the approach taken in other countries. There isn't necessarily a penalty regime. There may well be breaches of the law through greenwashing. Typically in Australia, that is an action that the regulator might take for an issuer making misleading and deceptive statements about the greenness of a project, or the data that the issuer is putting out there to the market to say this is a green project is wrong or based on incorrect assumptions or otherwise. So there's a multitude of factors that go into trying to address the whole question of greenwashing. It's been a global problem since green bonds were developed. Any time you have a product, a new financing product that is pushed to market, there is always the risk that you might move too quickly without the proper analysis being done, that you're actually achieving what the instrument is set up to achieve. So it's really about the analysis that goes into, is this a green project? Checking that proceeds are applied for that particular project and they're not applied to something else that's not green. So going against the whole purpose of the use of proceeds from the bonds. It's about monitoring compliance with ensuring the project stays green. Isn't just green on day one and then changes to something else. It's all issues around that sort of transparency type question.
Thank you for that. I see I also have a second question from Ambassador Francis. So you've touched on to his question about greenwashing. His other question was a little bit more drawing the distinction between what a climate bond is, what a carbon credit is, and what a green bond is. So over to you, James or Yang.
Yang, would you like me to address that one, or did you want to address that?
Yeah, if you would like, please.
Happy to do so. So look, climate bonds, green bonds, not dissimilar. They're both bonds for a different particular purpose. They're all about funding eco-friendly projects, essentially, making funding something that is good for the environment at its at its most simple. A carbon credit is something slightly different. I mean, they're both tools used to arguably fight against climate change, but a carbon credit is aimed at offsetting emissions that currently exist. So it's a mechanism to essentially reduce greenhouse gas emissions. We have the concept of carbon credits in Australia. Companies receive essentially a set number of credits that decline over time. It's an asset. You can buy and sell them as well to another company to help them with offsetting their greenhouse gas emissions as well. So basically, they're a financing tool that creates a monetary incentive for companies to reduce their carbon emissions. It's a slightly different instrument. Hopefully that answers the question, Ambassador.
Yes, I think that answers the question sufficiently. We have maybe another 10-ish minutes. And I can see your hand up, Sandra. Please put your question in the chat. I think the mics are all disabled. And so you'd have to type out your question in the chat. For those that are asking, the recording will be on GreenTAC's website. So not to worry if you joined a little bit later, if you had issues with your internet connection. I'm just looking to see if we have anything else. Just bear with me. Aha, we do have other questions. Good. So how does the green bond align with Ghana's climate policies, NDCs, and sustainable development priorities, looking at changing dynamics?
I don't think that's a question we can answer off the cuff, Mary, as it wasn't part of the scope of the report that we were asked to look at.
Yeah, that's fair enough. Then maybe we can move on to the question about, I think that's it really, because we've touched on credibility issues and green bond proposals being rejected for those reasons. I think there's another question that's come through. Just bear with me. So this is again Ambassador Francis. How will community and grassroots organizations, climate change champions, get their capabilities built so that they will understand the dynamics in reporting and lead their own organizations on the international front rather than foreign nationals leading? I hope that makes sense.
It's a very interesting question and clearly an important one for your country. It brings in a real educational piece, I think, in terms of getting that capability, in terms of skilling up, understanding the challenges with green bonds, understanding the data analysis requirements, the monitoring requirements, the use of funds requirements. I think it is like we do in Australia. It is important to look at the approach being taken in other jurisdictions, which is why I think a review like this is very useful when you are looking at moving into a different area. We would do exactly the same thing and do on regular occasions. It's useful to understand the approach being taken by different regulators in markets where there are synergies there in terms of things like greenwashing, in terms of disclosure requirements, segregation of funds requirements. But it is a look, it's a developing area. I think one of the benefits that Ghana has is you're not first to market in terms of these types of instruments. There is a lot of literature out there, a lot of educational tools available to upskill in the context of green finance. And like anything like this, it will just take a little bit of time to develop those capabilities.
Thank you. Thank you. And I think, just one final question is about addressing investor concerns. So, we've looked at it from the perspective of regulating the issuers of the bonds, but what about the people that invest? Are there protections for them where it is found, that things are not as straightforward or as aligned as they initially were meant to be? So just, a question on if the guidelines cover things like that, aside from, say, the resort to sanctions, really.
Yeah, so from a investor protection perspective, outside of the guidelines, you'd be looking to rely on the issuance documents, and that would typically contain all of your protections. So I think in a nutshell, that's the simple and very straightforward answer.
So going back to the comments we made about what a bond actually is, ultimately it's a contractual arrangement between the issuer of the bond and the investors. Has contractual terms as any finance instrument would have, including defaults, where the bond accelerates or repayment of the bond accelerates before its maturity date, and that may well happen where the bond loses its green status in this regard, because that is the whole basis on which the investor has invested in the bond. The other thing you may see from time to time is that the terms and conditions of the bond mean that if it loses green status, or if there's a question or something else happens, the interest rate payable under the bond steps up. So you go from maybe for an example, a 5% rate of interest, all of a sudden it steps up to an 8% rate of interest, reflecting that it's not the same instrument that the investor thought they were subscribing to. So the market in many ways will drive the consequences of the bond not being green, but it's the contractual terms of the bond are the primary protection for the investors in the bonds.
Yeah, thank you for that. I think maybe the final question that I can see on the chat is from Sandra. So Sandra says that during the presentation, you mentioned that the penalties under Ghana's guidelines might reach up to a maximum of $5 trillion, which seems to be disproportionate to project values. How do you think Ghana should calibrate these penalty structures to ensure they're effective deterrents against greenwashing without being so severe that they discourage legitimate green bonds?
Yeah, sorry. I think that was part of my presentation. So to clarify, the 5 trillion is in reference to the Australian regime, and was kind of a point of comparison. So I think for some further clarity, the penalty in Australia refers to about 780 million Australian dollars. And this is under a regime under which the penalty scales with the value or how deep the pockets of the offending issuer goes. And that was going to the point about how the penalties under the Ghanaian guidelines are capped at essentially 23,000 Australian dollars. So from between these two regimes, you have 700 million Australian dollars and 23,000 Australian dollars. So that's a massive order of magnitude of difference. And so to go to Sandra's second point, we think it would be something to be considered, that the cap on the penalty scales with the value of the project or the value of the damage, or the benefit or detriment avoided. So lining it up with the total project cost so that you're not imposing basically pennies on a multi-million-dollar project that you might have in Ghana.
Great, thank you for that response. We have a couple of questions that have come in. So the next question is from Rebecca. How often is the eligibility of projects reassessed after bond proceeds have been allocated?
Look, it varies a little bit. Sorry, Yang, did you want to? You can address that one. I think it was part of your report.
Yeah. So there isn't necessarily a prescribed sort of time frame that you have to re-examine it every few months or years. But the interesting thing under the Ghanaian guidelines is that it requires continuous disclosure at least annually. And the other point that we mentioned was that where there's a material development event that happens with respect to the project that would require immediate disclosure. So let's say the project is no longer green, meets the green certifications under the Ghanaian guidelines. That would arguably be something that is material and require immediate disclosure. So in that sense, there's continuous and at least annual reassessment as to whether it's still green or not.
Great, yes. Thank you so much for that response. And then we just have the final question. There are two final questions. I'll ask them together. So what are the mechanisms in place to ensure transparent allocation, tracking, and public reporting of green bond proceeds? I know you've touched on this briefly, but maybe just a quick summary. And then the final question, does water and air pollution have anything to do with what we're discussing? Again, happy to sort of let you take on those final questions before we wind up.
Yeah, sure. I think in terms of the water and air pollution point, it all goes to making an environmental impact. So to the extent a project is, let's say a dam or something is filtering or somehow assisting in cleaning up drinking water or providing drinking water, I think there's scope. An argument could be made that it's got green credentials, but that would of course depend on various other factors around the project itself. And then as to the mechanisms in place to ensure allocation and whatnot, so that is kind of goes to the reporting aspect of the core principles. So as we touched on earlier, the Ghanaian guidelines go a bit further than the green bond principles issued by ICMA, wherein we have separate accounts for each issuance of green bonds and, where relevant, sub-accounts allocated to each project. So Project A's funds are allocated under the bank account for Project A, and Project B gets allocated to the Project B, and so on and so forth. So I think that hopefully that answers the question.
Yes, thank you. I think it does. And I think that brings us to the end of our Q&A section. I will now hand back over to Nia. I see he's back on the call for some closing remarks and next steps / way forward. Over to you, Nia.
All right. Thank Mary, and thank you to James and Yan. That is what you have done there in terms of the questions, especially in line with the research that um, I'll just say that when it comes to investment, one of the things that our banking firms always requires is that what project you are bringing in terms of climate change, is it bankable? Something that is not bankable, and that is not part of the at how we can generate funds to support climate development in the country, and that is coming from the government, and so I mean, as we look forward in we will address them, especially as we have kickstart with maybe bring some capacity training to some of the members in terms of how can understand this green bond washing and then green loans and all those things are from Kenya, from Zambia, from Nigeria join will be able to of looking at how the country that they represent can raise the climate development. And back to us, I think to do some additions in terms of the next steps. We'll launch the maybe I will promise that all those who are on the call, we have your emails. So the report is ready. We will share via email to you to visit our. There are some information in terms of next steps. We'll put them there to use some of the social media platform we have, because it was through that we were able to get you to register to participate in this validation process. I also want to say a big thank you to participants who got the time to support us. We don't take that for, especially when you have other and you have dedicated some time to be with us and to also listen to issues that we are championing. So thank you so much, and stay tuned to any other news that we'll be sharing as part of next steps. Thank you. Over to you, Mary.
Thank you, Ni, for those warm remarks. Thank you so much, James and Young, for the work that you have done on this. As Ni has mentioned, you do, you've dedicated additional time to working on this on a pro bono basis. So we are heavily indebted to you, and really grateful that you made the time both to prepare the report and to attend this validation session. I think we've covered so much, and I think if I can sort of take it back to one of the questions in the chat where we're talking about how do we build capacity around this. This is how we build capacity. We do the research, have evidence-based research leading our advocacy efforts, speak to your members of parliament, people in the ministry, in order to ensure that they're well engaged and to ensure that citizens of Ghana are well engaged in these issues. Like we've said, climate change has a significantly negative impact on developing countries, particularly Africa, who rely on rain-fed agriculture, among other things. So it's great to see that steps are being made to ensure that we are adapting and mitigating the impacts of climate change as we continue to try and meet our other obligations nationally, to such as the provision of public services, social protection, etc. So, with that being said, thank you all so much for attending. I think we can now bring the meeting to a close. Thank you so much, Ni, for coordinating this validation session. We do look forward to the final publication of the report, which we will share. And I mean, should you have any further questions, I suspect majority of you are in touch with Ni already and have his email. Please feel free to send an email. And with that, thank you. Have a lovely rest of your day, and the recording will be shared, so you feel free to share it with your other colleagues and climate justice champions all over the continent, really, because there's scope for cross-learning or peer learning, and we're absolutely grateful for the opportunity that you've given to us today. So thank you all. Ni, I think you can end the event. And for me, goodbye.